Hey everyone, welcome to the webinar for the federal budget 2015, specifically related to startups and small business. My name's Steve Roberts, and I'll be taking up half an hour of your lunch break, going through what Mr. Hockey mentioned Tuesday last week, specifically related to the startup scene and small business entities. So I hope everyone can hear me out there. If you can't, just chuck something in the chat and I might be able to do something from my end and whatnot. So to start things off, I guess I will be talking about some of the measures that were announced in the federal budget, but I won't be covering all the measures. As I said, this is specifically related to startups and small business entities. But to start things off, I guess the budget at this stage is only really an announcement, so it still has to pass through the House of Representatives, then the Senate, and then it needs to receive royal assent before it's law. So technically, as we stand today, it's not law, but generally these things will be completed and go through the normal process, as I said, through House of Reps, Senate, and royal assent, all before 30 June. So if we run out and use these measures, I guess, today and now, you can place a certain amount of reliance on it, but just do know that I guess it technically isn't law at the moment, but it will be estimated before 30 June. Having said that, I guess these measures that we talk about today may be subject to some sort of change as they pass through the House of Reps and Senate, but only time will tell that. So, as I said, I'm going to be talking about small business entity and startup provisions. So first I should probably cover off what a small business entity is. Now, just quickly, a small business entity is an entity that first carries on a business and has a turnover of less than $2 million. Now, carrying on a business is pretty key in this, in the sense that it needs to be actively trading or carrying on some sort of business. It can't just be holding assets passively or holding property and you're not in the business of property development or whatever the case may be. So the entity needs to be carrying on a business and have that turnover of less than $2 million for these concessions to apply. Now, to start the batting off, everyone's pretty excited about it. The company tax rate for small business entities has dropped from 30%, or is going to drop from 30% down to 28.5%. Mr. Hockey said that that's going to be effective from 1 July 2015. So the tax year that we're currently in, all companies are still at 30%, and then from 1 July 15, assuming no changes, it'll drop down to 28.5%. Now, from a franking credit point of view, the franking credit rate will remain unchanged, so it won't drop down to the 28.5%. It'll remain at that 30% level, which means as dividends still flow out, the franking credit rate's that 30%. Now, obviously with the drop in the tax rate, for all those entities that are prepaying tax through the PAYGI system, it won't take effect until 1 July 2015, so you won't see a drop in your PAYG instalments unless, from 1 July 15, those instalments should drop down to that 28.5%. Now, that's the company tax rate that's dropped down to 28.5% from 30. What about unincorporated businesses? Mr. Hockey says that's okay. So, for unincorporated businesses, there's a different mechanism to I guess, deliver the same outcome or a similar outcome. So, what it is it's 5% of the tax payable on the business income. Now, the mechanism on how that works is that it's a tax offset, so it reduces the tax payable on that business income received. In the budget announcement, they talk about an individual conducting a sole trader business, but it can also, I guess, expand out to trusts, assuming that the trust is a small business entity, so therefore carrying on a business and turnover less than $20 million. So if an individual receives a trust distribution from a trading trust, I guess, the individual receiving that trust distribution can also gain access to this 5% tax cut. Now, as I said, that is a tax offset, and Mr. Hockey said that it's capped at $1,000. So the tax that you can save, the maximum in any 1 year is $1,000. Now that again becomes effective from 1 July 2015. So again, for the current year that we're in right now, up until 30 June 15, it is what it is. And then from 1 July 15 is where we'll see this unincorporated business tax cut, as well as the company tax rate dropping down to 28.5%. The other cool, or one of the other cool measures is the small business write-off for assets that are under $20,000. So if you're a small business entity again, and you purchase an asset between or after 7:30 p.m. on the 12th of May, all the way through to 30 June 2017, as long as that asset is purchased and stored ready for use between those dates, and the cost of the asset is $20,000 or under $20,000 excluding GST, then the small business entity can get an immediate tax deduction for that and does not have to depreciate it. Now, assuming that the small business entity does use that concession and it does want to write off assets under $20,000, for assets that cost more than $20,000, the entity must pool those assets. Now, what that means is that if, for an example, you buy a $30,000 motor vehicle, obviously the $30,000 is over the $20,000 threshold, so that asset must enter into the small business general pool, and then that's depreciated in the first year at 15%, and then every subsequent year after that at 30%. And the benefits of a pool, just quickly, I guess, is that it's not, or depreciation at that 15% isn't calculated on a daily basis, it's calculated on a period basis, so just keep that in mind. CDT rollover. So if a small business or a startup starts a business and gets advice or doesn't get advice on what they should do, and at some stage in the future they decide that the entity or the structure that they're in currently isn't for them, currently there's only relief from tax implications when you're an individual, a partnership, or a trust that wishes to incorporate or turn themselves into a company. There's nothing really that exists at the moment, for an example, for an individual conducting a sole trader business who wants to put themselves into a trust structure. So the budget, I guess, has given us an indication that there will be CDT rollover relief for small businesses where this may apply, where an individual does want to turn themselves into a trust or some sort of other entity structure. Now, the measure at the moment, it only applies from a CGT point of view, so a capital gains tax. It doesn't apply to things like transfer duty. So if we're transferring, for an example, IP, business assets or anything like that from structure, from the structure that you're trying to roll into something else to the final structure, there may be transfer duty applicable to those assets. So this doesn't give a relief for that, it only gives a relief for CGT. Now that's not effective until 1 July 2016, so not 1 July 2015 coming up, it's the year after that. We're yet to get some more details and clarity on that. Just quickly on the FBT front, so there's a little bit of confusion out there that portable devices, if you have say an iPad and a laptop and a mobile phone provided by your employer, they have to basically do the same function to get out of FBT, but essentially this is just trying to remove the confusion to say there's not going to be any FBT on more than one work-related portable electronic device. So if you have an iPad and a phone and a laptop, if they're all work-related, then there won't be any FBT on any of them. Now, I should make mention too that the FBT only really applies when there's an employer and employee relationship. So for the small business and startup scene, I guess if you do have employees and you are the employer and you're providing that employee with these devices, that's where this FBT is looking at. So if you give your employees multiple devices and they are work-related, then there won't be any FBT on them. Specifically to startups, so many of you, I guess, will ask the question on how to set up a company or how to set up a trust and what structure and those sorts of things. So any professional fees that you do incur in setting up a structure or a startup or a new business venture, I guess, the costs that you incur to those professionals will be immediately deductible to the startup or the small business entity. Now, historically, or as we stand today, those costs, you can still get a deduction for them. However, you don't get an immediate deduction for them. They're caught under what's called the black hole expenditure, and they're deducted over 5 years. So you get 1/5 of, say for an example, it costs $1,000 to set up a company. You'll get $200 in the first year and $200 and split over 5 years that way. Now, this is, again, effective from 1 July 2015, so I guess it would be prudent to wait until then, if you can, to set up a business so that you can access this and deduct those costs for professional fees immediately as opposed to over 5 years. Anything you incur between now and 1 July or 30 June will still be caught under that historical method of the black hole expenditure over 5 years. Startups and crowdfunding. So it's a lucrative thing. Everybody's heard of Kickstarter, no doubt. Essentially what it is an entity or a business who's getting small amounts of funding from a large amount of investors. So for an example, I wanted to start producing pens and I want $10,000 of capital, and I get that from 500 different people tipping in small amounts of equity. Now, currently there's a fair bit of red tape around it, and it's sort of limited to public companies and the requirement, I guess, from ASIC to issue a prospectus for the investment. We run into rules like sophisticated and unsophisticated investors. There's a lot of ASIC regulation around what can and can't be done. And I guess this measure is the government realising that it is something that the startups utilise because it's so lucrative, and it does help, I guess, small businesses get some equity in there. So what they've done is they've proposed to spend $7.8 million, give that to ASIC over the next 4 years to come up with a plan and some sort of regulatory framework to then be able to allow startups to crowdfund and not be caught up with all the public company conversion issues and regulations, as I've just said. So right now we don't really have many details as to how that's going to work or what that's going to look like or anything of that kind, but I guess it's a step in the right direction. So at the moment, I guess other countries are doing it thereabouts, like UK, US and New Zealand, but again, this is just the way that we can deal with crowdfunding. So for all of the startups, I guess there's a lot of registrations, and for small businesses there's lots of numbers and company indicators and business indicators on logging into various different things. And I guess the government's realised that it is quite complicated and is quite difficult for small business and startups just entering into that sort of business environment, knowing where to go for what and what registrations you need and those sorts of things. So the government have come to your rescue, I guess, and in some time between now and mid-2016, estimated to be mid-2016, they're going to create a single online business portal where you can access just about everything. So it's proposed that your ABN will be the single login indicator, and then that'll get you access to the ATO from a GST, income tax, FBT, PAYG withholding, PAYG instalments, registration details, It's also going to bring in the ASIC side of things. So currently, I guess you have an ABN, a tax file number, and an ASIC corporate key. That's all going to be still there, I guess, but just accessed through one portal, so you can access all those things in the one location. Employee share schemes. So I guess an employee share scheme, to teach everyone what it is it's where a business or a company, for an example, issues shares to its employees for whatever reason, call it sweat equity, call it whatever you want, at a discount to what the market value of those shares are. Now, the key concept in that is that the employees receive those shares at a discount of what an unrelated third party at an arm's length transaction would pay for those shares. So for an example, a startup business that say is worth $5 a share, and the employee can purchase them at say $3 a share. So the discount there would be $2. So the employee share scheme, I guess, looks at that discount, ties that back to the personal exertion and I guess the employee deriving that income through their employment, and tries to tax it. Now, the point in taxing, I guess, is the key issue. So we'll just quickly run through that now. So in 2009, they did change the rules with ESS, and essentially what it made it apparent was that the taxing point for that discount, that $2 in my example, was taxed at a point where either the shares were under restrictions, or the shares were, I guess, not liquid to turn them into cash. So the employees that were receiving these shares in a discount were getting taxed on the discount, but didn't have the cash or the ability to sell the shares to get the cash to pay the tax bill for the discount that they've received. There's a bill currently in Parliament that is proposed to make changes from 1 July 2015, and the budget, I guess, reinforces that and tweaks a few of those things in that bill. And essentially what the changes, or what the proposal is that the taxing point for that discount, that $2, is when the shares can actually be sold and when there's cash available to pay the tax on that discount. So it's just lining up where the taxing point and the ability to sell those shares and taxing point is, so they marry up, and the employees receiving it can actually pay the tax on it. Now, specifically from the budget, they're talking about that for a startup specifically, the discount received by the employee is on a capital basis rather than an income basis. Now, the difference that makes is essentially that the employee may get access to the 50% CGT discount. So in my example, if my gain was, say, $10, then it would be on capital account, and then assuming I can get access to the 50% CGT discount, then I'd only be taxed on $5. Further to that, options under an ESS scheme, so if I have the option to purchase shares at a specific date that's at a discount, are also caught up in this and are also on a capital basis. There's some other measures, so that's basically it for startups specifically and small business entities. The other things, or some of the other measures that I'm just going to quickly touch on that I'm not going to cover in detail today, there were some announcements for primary producers, aged pensioners, childcare and family measures, GST and multinationals. Now, I just want to spend 30 seconds on multinationals, in that the proposal is to bring in legislation so that multinationals can't shift profits away from the Australian taxation system. So what they're talking about there is entities that have organisations or businesses set up in, say, Hong Kong, Singapore and Australia and the US and whatever other country, and shifting profits out of Australia into those, I guess, lower tax environments where they really should be paying tax in Australia, and in Joe's words, I guess, they're not paying their fair share of tax. Now, whilst that doesn't have a direct relationship or impact on the startup or small business community, I guess it's an indication of where the government's going and what they're looking at. And in my experience, you know, I do have some clients that do have entities in lower tax environment countries such as Hong Kong, Singapore, India, and I guess it's more just for us to open our eyes and understand what the government's trying to achieve with that multinational stuff, and then I guess apply it to us so that when it eventually, or if it eventually filters down to the smaller end of the tax system, that we're compliant and that we're not, I guess, overstepping our boundaries. So it's an interesting point, and it's an interesting thing for us to definitely keep an eye out for, I guess. Now, for all the Silicon Beach people out there who got to attend the function that we hosted a couple of weeks back here at our premises, we launched a startup offer. Now, it's pretty exciting in the sense that it's $297 a month, or $270 excluding GST, invoiced on a monthly basis, so it's not one big upfront payment at year end, and the value that you'll get out of that monthly, I guess, subscription is contact with your accountant and bookkeeper during business hours for those pesky little questions as you're going through your business life. We'll pay your monthly subscription to Xero or whatever the software is. On a quarterly basis, we'll reconcile the bank accounts and the credit cards and prepare the BASs and lodge them if you're GST registered or required to be GST registered. And on an annual basis, the ASIC filing fee and registered office will be here at Vincents, along with the compliance, financial accounts and income tax returns. So essentially, we built this package for startups to go, look, for all your corporate governance needs, from an income tax and financial accounts and BASs and bookkeeping, we'll look after that for you for $270 a month plus GST. It's a great package. It's really exciting for me that I get to launch this, I guess. So if you're interested in picking that up, I'll go to questions in 5 seconds with my contact details. Feel free to flick me through an email or give me a call, and I can set up half an hour or thereabouts where I can catch up with you for a coffee or what have you to see if that's applicable for you and see if you want to take that up. So again, they're my contact details. So if you do have any questions, flick them in the chat now, or alternatively, feel free to flick me through an email or give me a call on that number 32284068, and I'll get back to you. And thanks for spending your half an hour lunch with me.